Hello Trade Pros, this is Victoria from Trade Pro Academy, and today we've got a great little video for you. As you probably all know, the talk of the town is commission-free trading. Commission-free trading has hit the financial industry by storm, and today we're going to be talking to you guys about commission-free trading, what it means, what it might mean for you, and how these big companies are actually getting paid to give you commission-free trading. So let's go ahead and get started. It'll be a quick little sit-down video for you guys. If you guys are enjoying the TPA videos, I really want you guys to subscribe, hit that like button. Let me know down below before we get started what you want to see. Do you think commission-free trading is a good thing for the industry, for traders, for retailers, or not? Then give me your opinion after I give you some information. So let's go ahead and get started. So there are four main players that have begun to offer this commission-free trading. You might know Charles Schwab, TD Ameritrade, E-Trade, and Interactive Brokers have all stepped up. Those are the larger players that all have stepped up to offer commission-free trading. So before it would be about $5 or so, $6 or so per trade in most of these platforms. Now offered for free. And why is that? Let's see. Even though they do offer commission-free trading, it doesn't really mean they're not getting paid anymore. They do have other incentives which did incentivize them to offer said commission-free trading. And it's all legal in the States, all of these incentives. So let's just dive into this, enough teasing. The main reason is that they sell the order flow for these orders to market makers. Now, before we look into that a little more, all of these stocks, once they did offer commission-free trading, really got hit on the stock market. Their value went down, and that is because a lot of missed revenue is anticipated from these commission-free tradings. Now, one of the larger guys here is losing quite the amount, and we'll look at that in just a bit. But what does it mean that they are now selling the order flow data? Now, that's a very, very interesting part. And how does that let them offer the commission-free trading? Keep in mind, this is all legal in the States. They are selling your orders, the retail orders. It's something similar to the FX books. FX books have two books, the A book and the B book. And the B book is the losing trader's book. So that means they might sell this order flow to market makers to potentially take positions against you and with the winning traders. Now, this is very common in the retail fashion, especially in Forex, and this is what these larger companies are now doing with this commission-free trading. They're getting offered a lot of money to actually sell the order flow. So if you put in 10, 15, 20,000 shares of a certain order, let's say Apple stock, you want to buy it, you put it in the market, you put your order in, they actually can sell that information to a market maker who can front run that position. Now, again, going back to Forex, after getting this information from the order books, let's say you go through TD Ameritrade and you say you want 20,000 shares of something, that order is already sold to a third-party market maker, and they can take a position against you if they think they can make money off of it. Now, I don't really know how much money they're paying for all this order flow for retail clients or whatever kind of clients, but it has to be substantial if they're willing to give up potentially $100 million in revenue for the commissions that they do receive, which we'll look at in just a moment with, in the case that is Charles Schwab. Other than being paid potentially ludicrous amounts for all this order flow in attempt to actually take advantage of this order flow, they are approached, these retail brokers are approached by off-exchange market makers. Now, how it works is these off-exchange market makers directly pay for the order routing that goes directly to them rather than to the exchange first. And this is what kind of crosses potential borders between legality and illegality, but for the time being, the SEC does deem this a potential legal move by off-exchange market makers, brokerages, and these large companies. Now, to add to all of this, what happens with commission-free trading, the first thing that you may think is that volume increases, the trades increase. Why would you not trade more if you're not being charged for more? Now, markets actually incentivize brokers on volume rebate. Now, what does that mean? The more volume that goes through the broker based on the stock market, the shares, whatever it is, the more rebates they can get from markets. Now, I don't know the exact thresholds, but we'll do some speculating here. Now, there are talks that they're incentivizing them at $0.003 per share of a rebate, depending on whatever the threshold is. And Why is that? Because it adds a lot more liquidity to the stock markets. The liquidity skyrockets, the volume skyrockets, and there are more market participants. And this is influenced by the commission-free trading, the ability to actually enter the market without paying that cost of doing business fee. Now, this only mitigates slightly the losses from the potential of commission. So again, if you're paying $5 commission per trade, companies like Charles Schwab are actually losing $90 to $100 million annually in revenue from taking away these commissions. Now, I don't exactly know how much money they're getting paid for the order flow routing data, but that plus the incentives, volume, and liquidity must equate to more than they're actually losing. Otherwise, this wouldn't be a probable or profitable business move on their behalf. They may be investing into potential years in the future where they think this commission-free trading will pick up. Maybe they might be losing a little more revenue this year, but next year and the year after that, they're probably blowing that lost revenue out of the water. Now, assuming that the threshold is about 20 million shares for these incentives by the stock market, and you're earning $0.003 per share extra. Now, assuming that an extra 50 million on top of that shares has been traded through your brokerage at that same rate, that's $150,000 of extra money. Now, that is only 50 million shares. On average, Charles Schwab at a $5 or $4.95 commission per trade, and if they're losing $100 million in revenue, that means there's 20 million trades annually through the broker. And that's just trades, that's not number of shares. So assuming that each of those trades is between 100 and 1,000 shares, their incentives, if they double or triple their trade quantity, their incentives would equate to about a quarter to a third of the lost revenue from taking the commissions away. Meaning they could be making about 25 million to about 35 million if they hit that liquidity incentive mark, not to mention the amount of money that they're actually getting paid for the order flow sales, order flow routing to the off-exchange market makers. Now, what does this mean for you as a potential retail trader or just investor, whatever it is? That means that if you have substantial orders and they're going through, if you have potential orders that you want to sell by whatever, how many shares, but it's a substantial order, you might get front run and get crappy fills, honestly. And what this does is it separates the bid and offer spread, giving you terrible fills and automatically putting you at a substantial loss. If they continue to spread, just because market makers at the off exchange are taking the positions before you and you're getting front run, or they're taking the positions against you, it could increase the spread between the bid and the offer and put you at a huge disadvantage based on these new commission-free trading rules. Now, the SEC deems this legal, but I think that as this progresses and you see a wider spread between the bid and the offer, and you get a decrease in volume and the quality of markets deteriorates, then the SEC will probably intervene in this matter. But for the time being, it is all legal, and people are overzealous about this fact, but they don't really know what's going on behind the scenes. Now, be cautious how you do take advantage of this. There could be potential pitfalls. Again, the widening of the spread and getting front run as well. Now, Interactive Brokers is slightly different. They do offer two options, the commission-free trading, and also they offer just the super low, ultra low commissions that they usually have through their smart routing SM system. Now, that is an option for people who don't want to get put in that commission-free pool, and I believe that data will not be sold to third parties. Now, again, commission-free trading might be great. It might be really good for the investor or the longer-term position holder, someone who does swing trade for a long period of time. But those who are a little more active might actually find it a little discouraging in terms of the spread widening potential and also being front run and your data being sold to actually third parties. We'll see if this is a good move by these companies. You can see a lot of their stocks actually did deteriorate in value due to this potential loss in revenue, but only time will tell on how this progresses. Now, I hope you guys enjoyed this commission-free trading breakdown. This is Victoria from TRADEPRO Academy. And smash that like button, subscribe, tell us what you want to see below. And we've got an exciting new series coming for you. Join us every day live in the trading room where we trade futures live with the team, with our members as well. We talk everything to do with markets, news, and news trading. Take care, everyone.